Hey y'all, it's Carolyn Bauerschlag, your friendly neighborhood realtor, and I'm here today with the most special guest I could ever hope for, which is my business coach and partner. This is Gabi Brennesholtz. We've been together now for 6 years. She's been kind of the person keeping me on the straight and narrow, so all the cool things that we do is a direct result of Gabi. So now you get to see her. And Gabi has since in the last I don't know, 6 to 9 months, you've moved from only being our wizard, pulling all the strings for our businesses. You are now the director and lead person for KW Wealth, correct?
It is correct. Yes, the stories are true.
Yes. So tell the group, because my network won't necessarily know, what is KW Wealth?
So KW Wealth is one of the latest business divisions that is actually helping real estate agents to change the game and to build wealth. I think that's not a secret out there that real estate agents may, in a lot of cases, make a lot of money, but they have a hard time understanding financial education and building their own wealth. And so we're here to change that narrative.
Yes. And prior to getting into KW Wealth, you had Gabi's Cash Flow Club, which I participated in as a result of your genius. And that's actually how I first got introduced to the idea of multifamily syndications, right? So you connected us, Gabi's connector is what I'm trying to tell you. So I found my way into multifamily syndications through Gabi's other clients, where we just kind of created a group think and got to evaluate deals as they came across each other's desks, which I just think is the coolest thing. So you, though, were interested in it for a different reason because you have a background in investing through your RV parks, correct?
Yeah, absolutely. So just to give your audience a little bit of background in regards to the real estate portfolio side of things that we hold, I actually had to pull the data just to see where we're at now in preparation for our time, Carolyn. So as a general partner, we hold 170 doors. We are co-owners of our carbon capture machine. And as limited partners, we are part of several funds that are in the debt space for land development, as well as co-owners of 12 mobile home parks. So a little bit of everything, but certainly real estate or energy related.
Oh my gosh, just in it to win it. So this really helped change my mindset from just generating income and putting it into tax preferred accounts that we're all familiar with, and really saying, okay, well, if I'm going to functionally change the way in which we live, cash flow is king, right? So we had or still have single family residences that spin off some cash. We put all of our funds in IRAs, but we got into multifamily because we needed the timing of the money to actually change our cash flow in the years that we say that we want to be financially free, right? So you came by multifamily investments about the same time I did through our network, correct?
That's correct.
And your risk tolerance, I would say, is arguably higher than mine. So how did you become comfortable investing in an asset class called multifamily that you hadn't touched before?
Well, I think a couple of different reasons. Number one is I'm very familiar and experienced in all things business, right? So when I think of multifamily or when I think of asset classes in the commercial real estate space, what I'm thinking about is it's just another business widget, right? So when you buy a car wash or when you buy a multifamily piece of property, you just have to get really clear on how much time you want to invest in the project, right? Learning about the business and really building your business and financial education around that thing and what are the upsides of that particular business, what are the downsides, and then time, right? How much time are you actually going to be willing to invest in learning this, right? And then skill and expertise. Are you going to be the person that is going to asset manage that asset, or are you going to serve in a different capacity on a team of individuals that make up this, so to speak, mega team, right? So when you think about time, expertise, and skill, for me, the business side of things makes a lot of sense, right? So what I will naturally do, and I think this is part of the question that you're asking, is I get obsessive understanding a particular business, right? What makes that niche unique? What are the upsides? What in a particular area makes this asset up and coming? And so the reason that we ended up landing in Mount Pleasant, which is just outside of Greater Charleston, was because when we identified that there were quite a few mom and pop multifamily unit projects that had been held by folks for decades with no rental increases, right? And then in combination with just the growth that Charleston itself has had bleeding into the areas of the outskirts, we just knew that this was going to be an opportunity we wanted to look into. So what we do now is we look at an average of about 223 listings off and on market until we find a property that simply checks a few boxes, right? And some of them I think you can hear is, where can we create the value add? And a lot of times the gift for us is when somebody hasn't been running their portfolio like a business owner should, right? With appreciation rates and rental increases and amenities that they should update or add to be able to charge more. Then it became pretty easy for us to see, my gosh, there are just several opportunities right there in the market that, in addition to a lack of inventory for folks to be able to buy or rent, that we just saw some great opportunities in that particular area.
Yeah, so you are looking at opportunities that go nationally. Like, you have resources, you have other partners, general partners that are aligned in these deals who are looking for deal flow, essentially.
Yeah.
Right? They're looking for off market, they're looking at on market properties, but you're looking at it at more than 200 before you say, I have a letter of intent that I'd like to submit for this property. Is that correct?
That's right. Yeah, the average as of yet is 223, because we do track it, because now that, as the numbers change on a quarterly basis, we're also noticing that now we're actually looking at more deals than ever. But yes, as of the last 60 days, the average is 223 before we
yeah.
Yeah.
Yeah, so that for me is the silent partner, because I participate in these so far as a silent partner. I do not participate as a general partner. That makes me trust and know that y'all are evaluating, that y'all are talented in this space, and that you are doing the diligence that I would personally hope to do myself. So your role shifted from being a silent partner, where you participate like I do, where you essentially buy a share of the property. Your role shifted into general partnership. Right. And general partnership comes with different risks. You are liable in different ways on properties. So what is it that made you comfortable with the risk of general partnership?
Understanding the business model is really what it came down to, and understanding that the same way that when you go into a hotel, right, the person that may be greeting you at the front desk is not the person that ends up, cooking your meal at the restaurant later on, or changing your linens. And it's exactly the same way in a syndicate. Think of them like mega teams where every person has a different set of responsibilities. And some people may have multiple of those responsibilities. But just knowing how the structure of a syndication works in a syndicate, and knowing how many folks are involved and how many of them are also full-time involved in those projects, gave me a lot of clarity that in the beginning, when I just looked into limited partnership investment opportunities, changed the level of confidence, right? Because I became educated. For example, one thing that is worth noting is that in our syndicate, and this will depend on with different syndicate makeups, but we have folks who are full-time in the asset management piece, whose job now is, because our general partners have grown as a syndication quite a bit over the last couple of years, who now manage all of the human resources. They manage the boots on the ground asset management. They will talk to the property managers on site. We just hired a CFO, and they're managing all of those day-to-day operations. I literally have nothing to do with it, right? And then on the other side, some of the other seats that general partners will hold are part of the fundraising, right? Building relationships, networking, and finding new investors that would want to partner with us for future deals. So there are about 5 or 6 of these different job descriptions that make up the syndicate, and just understanding what they are, right? By going to Bigger Pockets and listening to a podcast, or going to an investor conference to be able to understand it, or good old YouTube will probably give you those answers too in 30 minutes or less. It can be really helpful as you continue to think about how much time would I want to potentially shift into a career as a manager, a general partner of a syndicate.
Yeah, because you got a lot of people putting trust into your deals, right? Just anywhere from 50 upwards of a couple hundred people saying, hey, I want to be a part of what you're doing, right?
Absolutely
Okay.
Right.
So when you're evaluating risk on these deals, you've looked at 223 deals on average per letter of intent or closed complex. What is the lens through which you're evaluating opportunities? So you kind of touched on it a moment ago, where you're talking about the sort of suburban sprawl from Charleston out into Mount Pleasant, and how you're looking at those kind of macroeconomic factors. But when you're looking at risk and you're trying to evaluate, is this a good idea or is this not a good idea? What other factors come into play for you? Because there's interest rate risk, right? Macro, like if you're going to lock a loan that's adjustable rate interest or a balloon note for a flip, there's elements of risk in that. So what are you evaluating whenever you're saying, I think I want to move forward?
Yeah, and actually, I'm going to start with the bank relationship, because you sort of led the question there, but absolutely, right? So having great bank relationships is very, very important when you are a syndicate, because part of a great bank relationship can insulate you from some of the potential downsides, right? What we're going to start seeing in multifamily in particular now is that we had a low interest rate environment the last 5 years, right? So low commercial rates and syndicates buying on slim margins 5 years ago. Now that those notes are coming to, right, they're by balloon payments and potential refis, they're going to be in a world of hurt because with today's rate environment, they're not going to be able to be cash flow positive. So one thing that we look at in particular is, can we get into a deal that would have enough upside so that despite where we believe interest rates might be in the next 3 or 5 years when we go to refi with these strong bank relationships we currently have, are there commitments that those banks can start to make with us so that as we show that the business pro forma is getting to levels of new cash flow based on our pro formas, that the refis can happen sooner rather than later so that we're continuing to stay ahead of what's going on. So that's one thing. So value,
strong local bank relationships to negotiate where you think rates are going as part of your deal.
Yeah, and so what we will build into our pro forma are those different case scenarios, right? So we build in different types of spreads depending on these variables that we do know, right? We anticipate that interest rates in the commercial space are not going to go higher than 8.5%, 9% in the next 5 years. Why? Because we already see the economic indicators that will tell us that towards the later part of this year, commercial interest rates are probably going to go down slightly, right? So we look at the economic factors. Right. But on a micro level, what's important to notice is really how much under rent value are the properties that we're buying. In the most recent cases, right, and we hold about $43 million in assets down in the Mount Pleasant area now. All three cases, in all three cases, though, the rents were so significantly under market value that just from the rent increases alone that we knew that we could charge in the next 3 years, the upside of the pro forma would be in the best case scenario, which we have shared with our investors as they were getting into that refinancing, and to refi would be no problem with the bank relationships we have. So that's one thing. Where are the upsides? Which amenities can we increase? And what are the microeconomic moving patterns for individuals in that area? Meaning, how do we know that we can actually get to the occupancy rate, which for us would be anything above 90% or higher? And we end up purchasing our B grade multifamily investments somewhere around the 70s, like in the 70s occupancy rate. So there in itself is quite a bit of spread.
Huge spread, yeah.
So we look at occupancy.
20% more bodies in units, and all of a sudden your revenue is significantly better.
Exactly. And then the final thing we look at, of course, is also how much capital expenditures would we have to and project to invest in the next 3 to 5 years to make the amenities a little bit cuter, refresh the outsides, do some basic hardware upgrades on the insides that would warrant, a different clientele to come in that would want to pay for those amenities. And between those factors, you create a business plan like you would in any other business, and then you explain it to the bank board ultimately, right? And if they can see the business plan and how you intend on performing on it, voila, you have yourself a syndicate in the making.
Yep. Yeah, no, I think one of the interesting things, we've had the opportunity now to invest in 3, and it's been interesting to be able to sit back and watch the investor updates that I get as a silent partner that come through monthly, right? So it's full on balance sheets that are reconciled, it's income statements that are year to date, it's reconciliations against the pro forma, right? Like how far off of target or budget do we think we are? But then there's a little MD&A management discussion analysis at the beginning, right? That really says this is where we're at. And one of the projects in particular, they have a floating rate of interest on the project, and they said that they're putting some of their capital expenditures sort of on hold because they said, hey, our rents are going up kind of regardless, right? So we've done a good enough job getting more people in the door that we're pulling back on the capital expenditure because our costs are coming up in interest rate anyways, right? So they said if rents are up and we don't have to renovate and spend more money because we're spending more money on interest, that's what we're going to do. And so it's just been kind of interesting to see the pivots that are made alongside the timeline that is stated to you as an investor. And so I think what gives me comfort, at least as the silent partner, is that pivots are made throughout the 3 to 5 year period to adjust for what is ever changing in a market. So it's not a 5-year set it and forget it and we'll see you later, and hope that you get your equity multiplier. It's very much an active, living, breathing sort of discussion, right?
Absolutely. And one thing to note is in any syndicate that you as a limited partner would want to invest in, really the most important question to ask a general partner is what made you come up with your pro formas, right? You can ask for those pro formas. They will share with you a presentation of the highlights of the pro forma, because if you see the full underwriting model, right, a lot of eyes will generally glaze over. But number one, please know you can always ask for the full underwriting pro forma to be shared, and a good syndicator will absolutely share that with you if you're willing to spend an extra hour, right, digesting those numbers. But even at a high level, the number one question that I would ask any syndicator is, walk me through why you believe there is going to be this kind of upside. The other thing that Carolyn, that you may notice is one thing that we do is we actually advertise the most conservative numbers of our pro forma as the returns that investors should expect.
Yes, and that is what that. I'm conservative in estimates anyways, right? I want to look at the dirty side of the outcome, right? And I want to look at the middle of the road. The upside to me is very nice to have, but I want to look at middle of the road. And I would say the performance that y'all are putting forth to us are somewhere between the dirty side and middle of the road, so it's already skewed in a direction that is conservatively helpful, I think, in my analysis. And so people, the reason I'm asking you these questions is because people have asked me these questions. Carolyn, you're risk averse. Like, why are you just dumping, money into funds in Mount Pleasant and North Charleston? You've never been there. What are you doing? And I think it really is that trust, and not just trust, but like an understanding of, I'm dealing in other sophisticated investors who are not willing to put literally $20 million on the line for funsies, right? So
absolutely. That's the other thing that, right, for those of you who may be wondering, well, what are some of the other questions I should be asking a syndicate is, what's really important to me as a general partner and as a limited partner is to know that the syndicators are investing alongside me, right? There are syndicates out there where they don't have to put any money in. They're not required by law to do so, right? But then what does that tell me about your business model and your belief in the business plan if you're not investing alongside me? I have questions on that.
I do too. It's very interesting because everyone is beholden. These are SEC regulated investments, right? They have to communicate with their investors on the backside. That's regulated. But what information do you have on the front side? Like, I want to see your spreadsheet. Did you just take like a 20% multiplier and drag it through like your annual rent adjustments, or did you actually think about it? Is it more nuanced than that? Because if you just took an Excel formula and dragged to the right and said, this is my pro forma, I'm not good with that personally.
Although I will take a 20x multiple any day, Carolyn, any day. But the other thing, yeah, right. But the other thing that, oftentimes I also get asked is, if you know that the stock market can yield you 8% annualized over the history of the stock market, right? Then the question you may also want to ask yourself, if you're looking into any other types of investments, including syndications as well, if I do nothing, right, 8% is what I can get. Right. If I want to spend my time and learn a new set of skills and learn a new set of expertises, then maybe I want to be a landlord, right? But for a lot of people, the reality is if you have a job, you have a W-2, or you have a business that, a successful business you're running like you, Carolyn, you may not have a lot of time to learn a new career or add on more noise into your life, right? And that's where some of these other funds or investments can come in really handy. Why? Because they're going to outperform that 8%, right? 8% is the pref with which our syndications generally begin, and it's different for every syndicate, but 8% is tends to be middle to high range of what you'll get as a limited partner. But these payouts, right? If you're getting into syndicates that will return your principal in 3 to 5 years, 5 years, sometimes 7 years, then all of a sudden the velocity of your money, if you then don't spend it but reinvest it, kicks in quite quickly.
Right.
Maybe that's the difference of why it might behoove someone to think, what else is out there if the goal is to outperform an 8% return.
Yep. And so we're of the same sort of age. We came of age in the crash 2008. And I talk about this frequently, but I think it's relevant, right? I knew by the age of 22 years old that there was going to be no pension. There was going to be no golden parachute for me, right? Like whatever we were going to have in retirement, we were going to have to create. And I think sort of being existentially threatened is the words that I use around that, has really kicked it into gear for me to say what worked previously for other generations will not work for us, right? And so we have to think differently. We can't just depend on a 401k or a Roth IRA or, whatever benefits you get from a corporation. Like we have to make that. So figuring out ways to say, okay, I've checked those boxes and I've done those things that are tax preferred by anyone's normal standards, and then shifting and saying what else is out there is what the genesis was, at least for me. So it's been fun for me to really be able to walk alongside you and to have had the opportunity to have these doors open for me personally. And I would like to pass that on, which is why we're having this conversation at all, right? So I want to be able to have those opening conversations to my database as well. So on that note, if you're someone who's interested in investing and in this type of opportunity, how do they get connected? How do they get started? Should they research something in particular? What do you think?
Yeah, I would say, I mean, if you're really, really interested in just understanding holistically what this is all about, there's a fantastic book that, and actually I ended up bringing it, Carolyn, by Joe Fairless.
Book too.
Really one of the main entities in the space, right? He has an incredible fund himself. You will see him at any syndicator conference. I mean, he's all over the land of syndications, but I would say this is probably one of the Bibles to explore if you're thinking of a career change. And I say this, gravely, because it is not generally something that people will do as a side hustle. If you're planning on building your portfolio, in this way, then you're choosing a career change. You're probably going to want to sign up for training and a mentorship or coaching of somebody who has done this before, right? And has
a general partner, if you want to be a general partner, right?
Exactly.
Right.
But as a limited partner, I mean, if all you want to think about is, hey, how do I get these types of returns? Maybe Carolyn can help me run what this would look like. In fact, there's some really powerful examples on blogs where you can actually see how quickly your money adds up when you get these returns, right? And how in 15, 20 years, your entire retirement portfolio can be set up to just through syndications if you have a certain savings rate in place. I would go on Bigger Pockets, right? Bigger Pockets is a real estate network, investor network that has an incredible set of podcasts.
Podcasts are great.
Absolutely. Yeah. And poke around and just start to, think about it like a 75 hard, if you're familiar with the challenge.
Yes.
What if for 75 days you actually spent 45 minutes on understanding just syndications, right? And you actually spend 45 minutes listening, watching to any and all things. It wouldn't even matter what you would be listening to after 45 days. You'd have a pretty good base knowledge.
You have great base. Yes. Yes. I think the knowing somebody who's talking about it is a huge deal. So when you raise your hand, you say, I'm interested, those people that you're talking to can help plug you in. So to my database, if you have questions about this further, we've introduced the idea, we've gone a little bit deeper into what it is. I'm happy to help you continue to have conversations so that if you do want to be in front of one of these opportunities to invest, you can be. So that's my wish for you. And Gabi, I can't thank you enough for your time today. And we're here to answer any questions that you have about different ways to build wealth through real estate.
It's been my pleasure, Carolyn, and thank you so much for having me.
Thank you so much. Talk to you soon.